Welcome to the new era of video creation with AI stock picking. Today, let's discuss Microsoft. Here is the contents. Microsoft continues to be one of the most dependable large cap investments globally. Its massive market capitalization, over $3 trillion, isn't just from hype. It reflects decades of consistent revenue growth, brand dominance, and innovation. Microsoft's ecosystem touches nearly every corner of enterprise and consumer tech, including Azure cloud infrastructure, Office productivity tools, the Xbox platform, and more recently, a leading position in AI infrastructure through its stake in OpenAI and integration into Microsoft 365. But even the best companies can become overpriced in the short term, especially when optimism inflates valuations faster than earnings can keep up. For long-term investors, it's critical not only to choose fundamentally sound companies, but to buy them at reasonable prices. Microsoft is a textbook case where investors can benefit from patience. In this presentation, we'll review where Microsoft stock is currently trading, evaluate the valuation environment, and identify an ideal buy-in range for those planning to hold for a year or longer. The goal isn't market timing. It's strategic entry for a higher margin of safety and better long-term gains. Microsoft stock is currently trading near 420s, just off its all-time highs. This surge has been driven by investor enthusiasm around AI, cloud expansion, and its resilient enterprise software segment. But under the hood, the valuation is demanding. With a forward PE ratio of about 35, it's sitting well above its 10-year historical average of around 26 to 28. That's not inherently bad. Growth justifies some premium. But it also means there's very little room for error. When a company is priced for perfection, even small earnings misses, a weaker economic outlook, or changes in investor sentiment can cause sharp drawdowns. Microsoft is a dominant force in AI and cloud, but much of that growth is already assumed in the current price. Buying now may lock you into a long-term winner, but it could also mean sitting through months of sideways or declining prices before growth justifies the valuation again. As we continue, we'll explore where the stock becomes more fairly priced and the kinds of risks that could bring it back to that range. Based on both technical and fundamental analysis, a more favorable entry point for Microsoft would be in the $360 to $385 range. This zone reflects a more reasonable valuation, closer to a 28 to 30 PE, which aligns with Microsoft's historical average and long-term earnings growth rate. That level also happens to be where the stock consolidated previously, suggesting a potential support level if there's a market correction or sector rotation out of tech. Buying at this price allows investors to gain exposure to Microsoft's growth story without paying a premium for momentum. Long-term investors care about total return, and buying during periods of moderate fear or market softness tends to yield better results. This doesn't mean we're trying to time the exact bottom, which is nearly impossible. Instead, we're looking to identify a fair value zone where the risk-reward profile improves significantly. A pullback of 10–15% would be healthy, not alarming, and present a strong opportunity to enter one of the most resilient businesses in the world with less downside pressure. In the next slide, we'll go over what could trigger such a pullback and why it's not only possible, it's quite likely. It's understandable to feel FOMO when a stock like Microsoft is rallying. After all, it's a blue-chip tech giant with a stellar reputation. But even great companies go on sale, and it often pays to be patient. Right now, one of the biggest macro risks is persistent inflation and higher interest rates. If the Fed keeps rates elevated longer than expected, that could compress valuations, particularly for large-cap tech stocks, which tend to be interest rate sensitive due to their high PE multiples. Another factor is sentiment cooling in the AI sector. If growth slows or companies like Microsoft simply meet, not beat, expectations, that could trigger short-term selling. Historically, the best opportunities to buy stocks like MSFT come after 10 to 15% corrections when other investors are exiting due to fear or uncertainty. By waiting for a better price, you allow compounding to start from a stronger base. The lower your cost basis, the higher your future return, and the less painful any drawdowns. Think of it as buying quality on a discount rack, not chasing hype at peak pricing. To wrap it all up, Microsoft is a stock most investors would love to own, and for good reason. It's not just a tech company, it's an infrastructure company for enterprise productivity, AI integration, and cloud computing. That said, even top-tier assets can become expensive in the short term, and Microsoft today is a perfect example of that. The key takeaway is this: you don't need to rush into greatness. By waiting for a more reasonable entry range around $360 to $385, you increase your margin of safety and long-term return potential. That range reflects both technical support and a fair valuation based on historical earnings multiples. It's a reminder that investing isn't only about identifying strong businesses, but also about having the discipline to buy them when the odds are tilted more in your favor. Ultimately, buying great companies at good prices is one of the most consistent paths to building wealth. With patience and a plan, you can turn volatility into opportunity and avoid paying top dollar when the market is riding high on sentiment.